right, we are officially live here. I'm going to give it a couple minutes for other folks to get signed in, get going here. Probably get kicked off around 7:02 Eastern time. Usually like 2 minutes is a good buffer window. Let everybody get downloaded and signed in. All right, so there should be a ability for everybody, if you have questions throughout, obviously this is going to be more of a presentation. If we have time at the end, I'm going to try and hit the Q&A at the end. So if something comes up, feel free to throw it in the chat and I'll try to work through it at the very end if we have time. So I've got it slated for about an hour. We'll see how much we can get through. So with that said, I'm going to make sure my screen's shared here and we'll jump into it. So before we jump into anything too specific in the crazy, crazy litigious world that we live in nowadays, goes without saying, but none of this is intended as individual tax or investment advice, purely meant to be educational. I come from a family of educators as well, so I love doing these educational presentations. So, obviously we do work with CRNAs around the country. This is not intended to be a sales pitch. So really just want to give away the farm, so to speak, on a lot of things that we implement for clients, time-sensitive things specifically here at the end of the year, trying to boil it down to a couple key things to make sure you're knocking out doing 1099 work as a CRNA before December 31st. So with that said, we'll jump into it here. So really on the docket here today, just want to make sure, again, none of this is intended to be a sales pitch. At the very end, if you do want to learn, what we charge for our services, how we work for clients, all that good stuff, I'll take the educator hat off and put on the salesman hat at the very end for about 5-10 minutes. So until then, we're just going to keep it informational only. So we're going to run through all of this in depth. So I'm not going to read everything off the slide, but 5 key steps. We'll talk about the new tax law with Trump's tax bill this year, some of the key things that changed around specifically planning opportunities with 1099 high income earners like CRNAs, especially considering potentially working in multiple states. And then we'll break it down into a couple key case studies. So step number 1, we do this with all of our clients. We break down the tax picture. So really the goal here primarily is to avoid penalties and any surprises in April. So that's the main thing that we always try to do. And admittedly, it's kind of back to the napkin math, but what we always try to do is do what I call a tax projection. Prorate the income, get an idea of what that mock tax return is going to look like before the year's over, so we can make sure, one, that there's no surprises. So the first thing we want to make sure we're looking out for is hitting what the IRS calls safe harbor. So 1099 income, obviously, different than W-2, they're not peeling off taxes out of your paycheck. So you got a couple options. If you're the sole proprietor route, probably should be making estimated payments unless you're over withholding through your W-2 job. If you moonlight, if you're S Corp, obviously you're issuing yourself a W-2, you got to hit the withholding right there. Now, the IRS has basically like a cheat sheet. They call it the safe harbor. And essentially what it is a convoluted calculation where they essentially take, for everybody on this call, will be 110% of whatever your tax liability was last year. So example, let's say you make your tax liability on your federal tax return last year was $60,000. You need to pay into the system, whether through W-2 or quarterly estimated payments, 110% of that number. So it'd be 66 grand. Now, Uncle Sam wants you to pay into that in the quarter in which the income is earned. So if you're making quarterly payments, or maybe for some of you out there, maybe pleading the fifth, you haven't made any quarterly estimated payments, even if you make a massive one here before the next deadline, which is January 15th, to still count for 2025. If you didn't make any for the first three, they're still going to assess penalties there. But doing something is better than nothing, because these penalties with higher interest rates can be pretty substantial just for making an estimated payment. It's easy to avoid. Now, one key thing in nuance is the IRS. You remember I just mentioned the quarterly estimated payments. They are only affected essentially assigned to the quarter prorated throughout the year. The nuance to the rule to kind of circumvent that, the IRS views IRA distributions in W-2 income as if it was proportionally withheld throughout the year. Meaning you could go in and jack up the withholding on your W-2, or potentially take a distribution from a retirement account and over withhold on that distribution to avoid any of those under withholding penalties. Other things, tax-wise, just to be aware of, might make sense, would just be harvesting gains and losses before the end of the year. So let's say you bought a stock for $10, it goes down to $8. You can take that $2 loss and actually use it to reduce your other income. Any of the losses you don't use, they just roll forward into the subsequent years. It's not use it or lose it. So that's one way to intentionally kind of turn maybe an underperforming investment lemons into lemonade, so to speak. We've got a lot of resources, blog posts and stuff on this. We could do a whole hour presentation on just the nuances of wash sale rules, and tax loss harvesting, and direct indexing. What a lot of folks miss, though, is potentially intentionally pulling forward income into maybe a lower income year. Maybe you just graduated from, as an SRNA, you got this only a couple months of income this year. Maybe you just retired halfway through the year. Essentially, if you're married, the first roughly 97 grand of taxable income. So this is after all your write-offs. You can realize long-term capital gains at a 0% tax rate. That's one idea. Another idea, if you have kids, would be to set up an UGMA or an UPMA account, basically like a custodial brokerage account. And let's say you have a stock that you paid $8,000 for, and it's now worth $10,000. If you sell that in your brokerage account, you're paying capital gains taxes. If you gift that to your child and then sell the stock in your child's account, you can realize those capital gains tax-free because of how they're depending on how old your kid is. There's some nuance there, but we do that for a lot of clients, being able to, again, intentionally force income on the tax return, potentially tax-free. So step number 2, we want to make sure we're funding the right retirement bucket, and specifically putting the most money into the smartest account. So the goal really is put the most amount of money in the right container, right? So for a lot of, and I've seen this with a couple new clients we started working this year, they had a SEP IRA, or they used a very basic version of a solo 401k. So I'm going to do some more comparisons here, but the bottom line is the solo 401k 99 times out of 100 will make the most sense, whether you're a sole proprietor or an S Corp, just because it allows for a lot more flexibility, not only in how much you can defer into these plans, but also potential loans, reverse rollovers, backdoor Roth eligibility, everything that kind of plays into there. Deadline wise, we need to have the plan set up before the end of the year. Now, with that said, we can then identify to make the contributions, even if you're an S Corp or sole proprietor. We just got to be able to identify that we can make those contributions by the tax deadline. So time sensitive wise, we got to get it set up before December 31st, but we don't actually have to push money into these plans as long as it's appropriately identified if you're an S Corp on your W-2 or as a sole proprietor. Apologize for the coughing. We got the flu going through the house here with the little kids. The next thing I want to also make note of, so there's a super catch-up provision this year. So basically, the normal catch-up, I think $7,500 this year. If you're between ages 60, 61, 62, or 63, if you turned any of those ages this year, you can contribute up to 150% of that amount. So you can do 11,000 and some change. as a catch-up contribution pre-tax as an employee. Next year, it has to be Roth. It has to be after tax. So that could be, if you're in that age range, could make a lot of sense to hammer some more money in there. Just a quick little table to break down. The main takeaway here is we really got three main defined contribution plans. What the bottom line is with the solo 401k, you can put much more in there as an employee and as an employer, plus up to the $70,000 limit. If you're over age 50, you get the catch-up provision as well. More over to the same point, the after-tax component, if we opt for a solo 401k with some sizzle, can really open the door to a lot of other things. So most custodians, Fidelity, Schwab, Altruist, Raymond James, doesn't matter, they will offer what's called a prototype solo 401k plan. They don't charge anything for it. It's a way for them to gather assets by offering this quote unquote pre-templated approved solo 401k document. Now, the key is with this is it leaves a lot to be desired in terms of other provisions that we could actually qualify for. So most notably, the thing that's going to remain consistent is going to be this pre-tax amount. You can still defer the same amount there. You can still give yourself a 25% profit sharing. You can use the free plan from Vanguard or wherever the custodian is, right? What it's not going to allow for, and you can do Roth as well, but what it's not going to allow for is this after-tax component. So the after-tax component is huge because it allows for what's colloquially known as this mega backdoor Roth. So, and I've got some case studies here. We'll break down pretty quick. I got a lot of slides. I'm going to be sending this out afterwards to everybody. So not trying to rush through it. It's just a lot of info I want to get to. So with this mega backdoor strategy. So I got two scenarios here, and you can thank my wife, who's also a 1099 CRNA, for helping me come up with these anesthesia punny names here. So we got anesthesia, norepinephrine. Both are 35. They make W-2 income. They moonlight extra 35 grand a year, 1099. Now, one of them contributes, each of them both max out their retirement plan through the hospital, through their W-2 job. And anesthesia then sets up this solo 401k with the mega backdoor strategy. Essentially what she does is she contributes, without getting into we again talk a whole hour about how this is actually calculated, which we obviously do get at that point, but just for the sake of brevity and just to illustrate the impact of this type of strategy, she takes her 1099 income, she pushes it through this mega backdoor strategy, whereby she contributes it as an after-tax contribution and then immediately converts it over to the Roth IRA as a in-plan rollover or an in-service conversion to her Roth 401k. What this does is it now shields that money from future taxation on the growth. Compared to norepinephrine here, what she does is just saves the same amount of money into the same investment, into a different investment account with a different tax wrapper around it. In both scenarios, the money is invested exactly the same way. I'm just using long-term S&P 500 performance since the 1920s is about 10%. I'm using a conservative 8%. Just to illustrate the impact, right? So both accounts grow to the same amount, the same $339,000, both grow to. Anesthesia calls me up and says, "Hey Ben, I'm going to go buy a lake house. Send me a check for 339 grand." Because it's in that Roth account, it's completely tax free. Nora calls me up, says, "Hey, send me the same check." We now have to pay above and beyond what her basis was, her original contribution to the total growth, the long-term capital gains rate. And where she is at that time at the highest rate, potentially not accounting for state taxes if you're in New York or California, she's going to give away almost $72,000 of that. We didn't do anything magical investment-wise. We just changed the account where we saved these dollars into. This is only 1 year, right? I mean, we can really extrapolate this and say, okay, what if she did this every year of her career? I mean, it really could potentially mean retirement years sooner, right? And achieving financial independence even sooner. So got a couple quick scenarios here. Again, Just going through these quickly, clients under 50 years old, they got their LLC taxed as a sole proprietor. They don't contribute anything else. They got net self-employment income after they take their write-offs for mileage and vehicle and other things we can talk about. Their 2025 solo 401k contribution, the most they could do is 70 grand. So we put in 23.5 pre-tax. They give themselves a profit sharing component. And then here's the key. We already pulled all these levers pre-tax, but with this other component, with the solo 401k, we can now stash away another $9,200 into this plan. One more quick scenario. Everything else is the same, but now we've got an LLC taxed as an S Corp. So they make $150,000 they pay themselves through their S Corp. They take a profit distribution on their K1, which is just the component that isn't subject to the self-employment taxes from their S Corp tax return. So they make 250 grand total, basically. Now it's based off of the W-2 income. So they give themselves they contribute the max as the employee, give themselves a 25% profit sharing as the employer, and then their after-tax component goes up to still aggregate to that $70,000 limit. So just one more quick slide on value of the mega backdoor. Let's say we did that same $9,000 a year for the next 20 years. We got a bunch of assumptions on here. I'll spare everybody the details, but basically I'm using long-term investment performance. It's no guarantee of future performance, obviously, but then just long-term inflation, long-term tax rates. And I try to quantify the same thing. We do this for 9 grand every year for the next 20 years. The brokerage account, just the growth component grows to 254,000 versus the Roth component growing to 387. They're invested the same way. Everything else is equal. This Roth just has a tax protection wrapper around it. You come out ahead pretty substantially in the long run. One more idea just before we kind of put the retirement account type conversation to bed. We've done this for a few clients in the few recent years here. Especially for those folks getting closer and closer to retirement or live very well within their means and are just trying to save a ton of money on taxes. This could potentially add up to hundreds of thousands of dollars in deferral amounts into these plans. There's a ton of moving parts to it, but essentially what a cash balance pension plan is if a 401k is a defined contribution plan, a cash balance is a defined benefit plan. Basically what they do, we use a third-party team of actuaries. They look at your income and they project it out and say, okay, what would the pension benefit need to be down the road? And how much do we need to fund it today using a reasonable rate of return? The cool part with the cash balance pension plan compared to like a normal pension, when you think of somebody who's worked for the same company for decades and now you're tied to whatever this income or insurance product or annuity you're invested in. When you retire, we simply terminate the plan and then roll it over to an IRA. So you maintain all that flexibility otherwise, but it allows you essentially to stash away a ton more money pre-tax. And you can do it in combination with your solo 401k. So a ton of considerations here. There's a ton of moving parts. If this is something you're interested in, they're kind of expensive to set up because of all the annual testing, probably a couple $1,000s a year. With a third-party company that we refer it out to, but ultimately a couple grand in expenses versus saving 6 figures in taxes, right? It's a drop in the bucket, given what some of the income potential with 1099 income obviously is out there. So step 3, we're going to talk about entity payroll stuff before the end of the year here. Really the goal here is to make the S Corp work for you, not against you, right? So we want to get that final payroll right by 12/31 and drive that deferral room as far as how much we can put away into these respective accounts in FICA taxes, those payroll taxes, and how you're exactly paying yourself a wage. So when does an S Corp make sense? We want to have stable 1099 income, multi-year horizon, typically not working in multiple states, but it depends on the states. But a lot of times these unemployment taxes can almost like cannibalize all the savings from even going down the S Corp route if you're going to be in multiple states. And there's some other things, QBI interaction, multi-state payroll, are you married, per diem reimbursement. But ultimately, the main idea with the S Corp is you pay yourself a reasonable, quote unquote, reasonable salary, which we can help you determine. and that reduces how much you pay in that 15.3% of payroll taxes, Medicare, Social Security taxes. So the main thing I see all the time, like let's say you're paying yourself $150,000 salary through your S Corp. In you're self-employed, you're maxing out your HSA and you're maxing out your health insurance. You're paying for your health insurance. When you're a greater than a 2% shareholder in your S Corp, which obviously we all are, right? Usually the only owner, you have to pay the HSA contributions and health insurance premiums as a wage to yourself. Now, the cool part is with an HSA and with a health insurance, it's not, while it does have to be included in your gross income, it's not subject to FICA taxes. So we can actually use that number to get you to that $150,000 in reasonable income. So let's say between your HSA, make math easy, between your HSA and health insurance, it's $20,000 a year. What we would do is pay you a wage of $130,000. Only that $130,000 is now subject to that 15.3% of FICA taxes. But we get to count that extra $20,000 as income, not subject to that 15.3%, which that alone saves you about $3,000 in payroll taxes. But we still get to use the full $150,000 to count towards that reasonable salary and to count towards the solo 401k contributions in maximum deferral amounts. So it's a neat way to kind of sidestep that. Now, functionally, what happens is you're reporting it as income on your W-2, and you're taking it as a deduction on your S Corp, your 1120S tax return. So literally, you're not getting a benefit then, right? You're including it as income here, taking it as income as a write-off on the other side. Then what we do is we take it as an above-the-line deduction on your personal 1040 tax return. So you still get the full write-off for it, but now you get to lower that S Corp salary and save you the $3,000 in payroll taxes. I see this one missed all the time by clients that have CPAs and financial advisors, but the two aren't talking to each other. So the stuff can slip through the cracks. Accountable plan. I see this all the time as well. When you're a greater than 2% shareholder, any of the mixed, quote unquote, mixed business expenses, stuff that's not 100% 1099 income, AA&A dues, malpractice, that stuff's obviously just for 1099 work. Travel to go to a, CE, so, stuff along those lines, that's 100% 1099. Now, what about the mixed use stuff where, part of your cell phone bill or part of your internet or your home office, your mileage, your vehicle deductions, those aren't 100% business use, right? Your iPhone you still use for personal. So how do you pay yourself that out of your S Corp? The IRS says you have to have a written plan in place, an accountable plan of how you go about reimbursing your employees. And it has to be done in a substantially periodic frequency. So what we do is we have our clients do that quarterly. You fill out a spreadsheet, you move it from your business account to your personal account. We label that as personal reimbursement, goes as a line item on your personal tax or on your S Corp tax return. Basically, it allows you to move that money out of your business account to your personal account tax-free. You just got to do it the right way. If you're ever audited, that's the IRS is going to want to check on that. Compared to the sole proprietorship, when you're an LLC taxed as a sole prop, you don't need to do anything special. We can take the write-offs at the end of the year. Last thing I'll kind of plug here is this acronym PTET, pass-through entity tax. With the extension of the OBBBA, the Tax Cuts and Jobs Act extension from Trump earlier this year, what they, if you remember, it took forever to get through Congress. One of the big sticking points was this SALT cap, so the state and local tax cap. Before, you could only write off 10 grand. Now it's 40. So what we would do in prior years with self-employment income is do this pass-through entity election where it circumvented that 10K cap. Most of the time, most folks aren't going to have state taxes over 40 grand. But that's something we could look at, run it through the S Corp. That would definitely be a flag this as talk to your CPA about it type of thing, because there's some nuance there in how it's calculated. Number 4, we're going to go to benefits that we got in our control. So grabbing some easy wins before the end of the year. So the goal with this slide, get the easy money right. right? So I just mentioned the HSA payroll to save now for FICA taxes. In the timing, the contributions we have until the tax deadline, but obviously you got to generate your W-2 and run that before the end of the year. So you don't actually have to push the money into the HSA until your tax filing deadline, which is March 15th if you're an S Corp, April 15th if you're a sole proprietor of next year. But if you're an S Corp, you really have to have it reported correctly on your W-2, which means it needs to be done by December 31st. Same thing with health insurance, self-employment premium deductions, running that through appropriately through things, making sure you got all the benefits dialed in for the next year. Disability, own occupation coverage, malpractice, adequacy, not a product pitch there. We don't sell insurance, just kind of like check it lists, things to make sure you optimize going into the new year. And number 5, we are going to talk about some write-offs here before the end of the year to make sure they're dialed in. The goal, again, with this slide, we don't want to leave any crumbs, right? Every dollar counts. Where some of you on this call are, potentially in 40% tax brackets, depending on state, federal, everything included, every dollar is really impactful. Even a $500 write-off could be a couple $100. So go through this at a very high level, but we talked about home office. Basically, the requirement there, it has to be exclusive and regular use, right? So if you ever had an audit from the IRS, there can't be a bed in the room or something along those lines. So it has to be strictly for, you to work when you're not in the OR. Again, with the S Corp, it has to be done through the accountable plan. The vehicle deduction component, you basically have a choice there. Say you drive 10,000 miles this year, 7,000 of them are for business. Okay, so you've got a 70% business use with your vehicle. You got a choice. You can either take the mileage, which is whatever it is this year, 70 cents a mile times 7,000 miles, or you could take 70% of your insurance, your interest on your loan, your lease payment, gas, car washes, maintenance, potential depreciation if you own the vehicle and don't lease it. We'd be able to take 70% of all that. And then obviously, scrubs and equipment, stuff like that, that is 100% business use. The key with some of these things is you really want to consider, specifically, I know that the big thing with OBBA tax bill was passed was they restored this accelerated depreciation on vehicles. Had a client that just bought an Escalade. The big key there that a lot of folks miss, and I'm sure you see on social media a lot of how great this is there's eventually recapture on the depreciation. So you buy this Escalade, you take $100,000 write-off. When you sell it in 3 years for 50 grand, let's say, you have to recapture that $50,000 as income. So you got this benefit today. You lost 50 grand on the vehicle. You still have to claim 50 grand back on the vehicle. And maybe you're retired at that point or in a much lower income bracket. So there's some arbitrage there and some planning around. It's not just about how much you can save in taxes this year, but over the rest of your life is super important. 529 contributions that can save with state taxes. You want to make sure you have a state specific plan. Gifts to kids. We already talked about like maybe the potential with the UGMA or the UPMA account to minors when they're less than 18. Flexible spending accounts, use it or lose it. So make sure you use that by the end of the year. And then we'll talk a little bit more about the charitable bunching on this next slide. And then you just want to make sure, we use either QuickBooks or Xero. XERO is great. We don't have any affiliation with them or kickbacks. Pretty simple software. You link your bank accounts up to it. You can categorize things. You just want to be able to, once a quarter, at least be logging in, reconciling, making sure stuff's not out of whack. Save yourself a ton of headache, in the long run there. Last thing before we jump into the 2 quick case studies, we talked about the SALT cap. So they bumped that up to 40 grand. So that's going to include any state taxes, license tabs that you got to put on your license plates for your vehicles every year, and then property taxes. So it wouldn't make sense to do that pass-through entity election for an S Corp unless your state property and vehicle state taxes are all going to exceed 40 grand, which that's pretty substantial, right? I mean, we're talking $700,000-800,000 of income if you were here in Michigan to be even close to that, especially if you tack on property taxes, depending on what you owe. So the other big thing changing this year, this is a major planning opportunity. So if you are charitably inclined and you donate every year, it might make sense to quote unquote bunch your deductions into 2025. So every dollar right away, if you itemize, you're getting that write-off. Now, next year, they put in place this AGI floor. So essentially what that means is, let's say you make $1 million in income, to make math easy. The first 0.5% of your AGI, your adjusted gross income, you don't get a write-off for. So let's say you make $1 million and I donate to the church $6,000. You're only going to get a write-off for $1,000 because it doesn't start until after that 0.5% floor is exceeded. So it might make sense to do your gift for next year or even subsequent years more into this year, where you're not going to have that floor, where you're not, essentially getting a tax benefit for it. One of the best ways to do that would be using a DAF, or a donor advised fund. It's a type of account where you can basically front load all your contributions in 1 year. That doesn't mean the charity gets it right away, but it allows you to take the write-off because you essentially are gifting the money into this fund, and then you can parse out the money in subsequent years, but you get all the benefit in 1 year. And then we talked about the catch-up contributions. That the super catch-up this year is only pre-tax. Next year, subsequent years, it'll be for high earners, which everybody on this call will fall into that bucket for 2026. And then the last thing here, Affordable Care Act stuff going back and forth through Congress. We'll see how a lot of this plays out. This is really more impactful for folks in retirement or very close to it. So modeling out Roth conversions, maybe you're an SRNA that just got done with school. We could pull forward some things in, again, lower income years. Those would be the big planning things there. So 2 quick case studies. We've got Anesthesia, our Moonlight 1099 CRNA. She is listening to this webinar and is pleading the fifth and realizing that she is way behind on making estimated payments. So what we could do is bump, and we'd have to jump on this because a lot of folks, it's beginning of December here, probably our maybe 1, if 2 pay stubs would take effect by the end of the year. We could hammer more money into a retirement plan, drive down the tax liability, and over withhold on whatever's left over. Then we could use that employer profit sharing into the solo 401k, 1099 income, side income with that backdoor Roth, like the example earlier. Then we got norepinephrine here, full-time S Corp CRNA. We want to make sure the salary is reasonable. Had a client that we started working with last year, CPA, said that she should pay herself almost a $190,000 salary just so she could max out her SEP IRA. You can max out the solo 401k with way less of a salary. And we obviously would have to do some testing to make sure it is still reasonable. Running the accountable plan through the end of the year here for those mixed use reimbursements. Talked about the pass-through entity election. Decide if it makes sense to acquire any equipment, like a vehicle, for the end of the year with the nod to the future rates there. And then really calibrating things, low-hanging fruit on that W-2 that's being run through payroll as far as the HSA and the health insurance write-offs. So I'm going to pause there before I move on and see if there are any questions rolling in. So let me see here. All right, I'm not seeing any comments coming in quite yet. So I'm going to run through kind of our way of doing financial planning. And then this, again, isn't the sales pitch part. That'll come at the end. So really our version of doing financial planning. And again, you'll see a lot of references to kind of the healthcare analogy. I think there's almost like the silo syndrome in financial services where, the left hand doesn't necessarily know what the right hand's doing, just like sometimes in the OR, right? I'm sure everybody agree with. So our way of kind of triaging the financial current situation for our clients really harkens back to kind of like that doctor-patient model. It's not a sales model. right? No doctor has ever been excited to sell a cast. They prescribe a course of treatment, and then it's up to you to follow it with the right guidance, hopefully. And a good doctor, anyways, takes tests, measures scores based on your personal health. And the first thing that they're going to do is start with your history, which we would have already talked about, with all of our clients. And then they're going to be able to take your vital signs, right? And if you have high blood pressure, they're going to want to get that under control before you have a heart attack down the road, and address it. So by monitoring, really those leading indicators of future health, we're almost able to practice like preventative financial care in a sense and quickly triage any existing issues. So our way of doing that is with this scorecard. So again, admittedly, there's kind of some simplicity here. But I think like most solutions, there's almost some genius in the simplicity. And I found a lot of CRNAs are a pretty competitive group. So it almost gamifies, what these scores are. It's usually, all right, who's got the highest savings rate, right? Versus, overcomplicating things, because that's what appeals to me, right? Versus being able to have actionable insights. So through this scorecard, and this will kind of be the call to action at the end of this webinar, what I'll do is I will record a quick video. If you fill out the 5-minute questionnaire so we can complete the scorecard, I'll fill out a quick video and I'll answer these 4 questions when I send it back to you. So are you taking the right amount of risk? Are you using your income wisely, right? Are we optimizing, any glaring issues here in terms of your overall tax rate? How much of your income is going towards debt, your burn rate, your savings rate? In theory, this row should all add up to 100%, right? Money's only going one of 4 places. And then do you have the right mix of assets? Not only, where should we be funneling additional savings or pulling from to bridge income in retirement? 2 quick examples. I've got a client, a couple $1 million all in pre-tax money. He maxed out his plan the whole year. It's not a lot we can do tax-wise. He needs 10 grand a month to live off of. That's the only lever we can pull. It's all pre-tax money. So for folks that are still working and saving, I want to kind of skate to where the puck's going, right? And preserve as much flexibility in functionality as we can of, all right, we get to retirement. Let's pull 2 grand from this account, 3 grand from this account, because who the heck knows what the tax code is going to look like 20 years from now. I want to preserve as much optionality as we can. Another client that I have has a great rental real estate portfolio. Everything's paid off. They wanted to take this big cruise last year. They couldn't because they're basically on a fixed income. He has this huge illiquid asset in a bunch of real estate. So the key is we want to, skate to where the puck's going and use just like a normal, like a vital sign scorecard. Each one of these is going to impact the next. And then ultimately, how much wealth do you need to make work optional, right? What's that financial independence score? So we put all this together for our clients, and it is kind of a pragmatic way to really distill down actionable advice without having to look at thousands of pages of spreadsheets, just because what appeals to me. I can tell everybody on this call, like my wife could not care less about looking at spreadsheets and a 100-page long financial plan, right? So again, talk more about this, but the main deal here is each one of these scores has a target range that we try to get to. We're just like in healthcare score, it's atypically high, typically low. And it's neat because probably 90% of our clients at this point are CRNAs. So we then benchmark specifically against not only your age group and your income bracket, but your specific peer group demographic for your cohort, right? For CRNAs in this age group at this income level. So we can really get granular, when we map out all these different scores. And we put together the scorecard here. Obviously, some of this is a little redundant, but really it all harkens back to kind of the saying, what gets measured gets managed, right? So I think those that measure, talking to prospects and clients all the time, those that measure their progress by the Standard & Poor's, right, the S&P 500, have a very poor standard, in my opinion. I think for progress to be meaningful, it has to be highly personalized. It's kind of like the track coach that says, hey, we're going to take this kid and have him run the 400 and I'm going to clock you. And that's going to be your personal best. And from here on out, we're going to try to incrementally improve on that personal best. That's a way to measure personal progress rather than an arbitrary, you need to have X amount of millions of dollars to retire, everybody's a little bit different. And this is our way of having progress being highly meaningful, and has to be highly personalized. So I will also send this out at the end of today. But if you're watching this on your desktop or on your phone, if you want to screenshot it, I'm going to send the replay of all this to everybody. But this is kind of my call to action. So scan the QR code. Don't spend more than 5 minutes on this questionnaire. I don't need to know to the penny, right, what's in your checking account. Just very high level numbers. Make sure everything's accurate. If you could do me a favor and label like W-2, 1099, S Corp when you put the income in there, that way I can really crystallize answering those 4 questions for you. So I'll happy to send that out as kind of like a reward for sticking with me through the presentation here. So I'm going to check the Q&A one more time. Let me see. All right, no other comments. So I'll go into the quick sales presentation for you. I'll make this quick, but really a couple things: how we work with clients, how we get paid, what we charge, ongoing experience, all that fun stuff. So with that said, every client that we meet with, we put together a 1-page plan, right? So moreover to what I was saying earlier, almost in like developing in my mind an ideal relationship, not to sound cheesy, but like if I wasn't around, right, what I would want it to look like for my 1099 CRNA wife looking for a financial advisor and a tax preparer. I try to look at it through her eyes. And again, she could not care less about a 1,000-page long Monte Carlo simulation. And we definitely do that. And there's certainly a place for it. But I've learned that most folks just want to know 2 things, right? Am I on track? What do I got to do next to stay on track? So I think a lot of advisors out there try to create this complexity, which I certainly have done. And I'm sure everybody would agree in the first half of this presentation here, because some of these things are unavoidably complex, but ultimately over time, trust is earned. And most folks I found just want to know those 2 things. Okay, are we good? Are we doing everything we should be? Great. So that's why when we meet, I try to put everything on this 1 page. What are the goals we're working towards? And then what are those immediate next steps to stay on track? And I think a good advisor, like a good doctor, should help you track progress, over time. So for every single meeting, we send this out usually a few days in advance. Hey, here's what's on the docket, what we're planning on running through, in addition to, investment performance reports, tax projections, any of the timely thing, insurance analysis documents. We get all that ahead of time. That way it's, oh, Ben, I forgot to tell you, I think I'm picking up a contract in another state, or we had a baby, or we're getting divorced, or whatever the life event is. Let's get it added to the docket and make sure, we have time to research things too as well. We talked about taxes, right? So taxes are the biggest expense any of us are ever going to have in our lives. So, like, again, that silo syndrome where patients seeing multiple specialists, they don't communicate, financial and tax decisions, I found are often made in isolation too. And what I see all the time is just missed opportunities. The software nowadays, it's very tough to have errors, right? And most accountants are great at putting numbers in boxes. Hey, here's my W-2, here's my write-offs, how much am I getting back? What I do see all the time is missed opportunities, where, again, to beat the medical analogy to death, a misdiagnosis can be just as harmful as the wrong one, right? And in taxes, failing to plan is just as costly as making an outright mistake. So our value, maybe differentiator to a lot of other tax firms out there, is we do real tax planning, meaning taxes are a very reactive process. You get to the end of the year, you meet with your accountant, he puts the numbers into the boxes. So we try to flip that on its head and make it a proactive process where we get together with all of our clients before the end of the year and do what we call a tax projection. Give me your year-to-date pay stubs. We map everything out, and we literally put together like this mock tax return to make sure we don't, 1, have any surprises, and 2, we're not leaving any money on the table. With any of the things we've talked about today, I can't tell you how many times we miss, like, all right, we started working together in January, but we can't really do anything. The year's over. We needed to do all this stuff before the end of the year. So that's get off my soapbox on the tax front, but really the biggest reason, this is my firm. One of the biggest reasons I started the firm to begin with is primarily, almost like the wrong way of doing things, working at other firms in the past. And I do see a question from you here, Patrick. No, we work with clients in every state. So right now, I just counted today because I wanted to bring it up on the webinar. So we actually have clients in 26 states right now. Probably be, just based on folks we're onboarding right now, probably closer to 20, 28 or 29 before the end of the year. So work with clients in all 50 states. We've got 2 CPAs on staff. I'm an enrolled agent with the IRS as well. I'm a certified financial planner too, kind of set up as a one-stop shop. We have a paraplanner. We have an additional just client service associate too. So small little team intentionally, but really the big focus obviously is very, very tax forward, which is why everybody's on this webinar doing 1099 work. More just client experience stuff that we put together. So kind of bookending the year. So we talked about that tax projection, meaning in the fall, in the spring during tax time. Not only are we filing tax returns for all of our clients, but we're also putting together what I call this, and maybe I'm my own head trash and like just being more visual. I want to see where the money's going to be coming in at. I want to visually map out, hey, here's where I think I'm going to be. Here's how much we should be setting aside for taxes. Here's the lifestyle that we're shooting for at the top in terms of expenses, whether it's prioritizing debt, housing, maybe it's an ancillary goal. We want to make accelerated payments down on student loans. There's some creative things we can do there. And then ultimately, how much should we be setting aside? So it's a lot easier at the end of the year than say, okay, if we want to pull every lever, backdoor Roth, mega backdoor Roth, maxing out solo 401k, putting your spouse on the payroll so they can max out their solo 401k through the W-2 job, a cash balance plan. We want to do all these things. That's great. It's a lot easier to start setting aside money month to month and almost treat it like an expense so we can go ring the register and pull all these levers before the end of the year, rather than me calling you in March at tax time saying, okay, write a check for 116 grand. It's a lot easier to peel it off and just set it aside throughout the year. But you got to be proactive and map out all these different, decisions throughout the year. Don't worry, I'm not going to read everything off the slide here word for word. But the idea here is, your money, our services. So, really putting together a full financial plan, everything that goes into forging a durable financial plan. It's less about just putting together a one plan and getting one-time advice. The analogy I always use, and not analogy, a quote from Dwight Eisenhower in World War II. They asked him before they invaded D-Day in Normandy, and they said, "What's your plan?" And he said, "Plans are worthless. Planning is everything. Tax codes change, investment markets change. As soon as we build this, it's immediately out of date." And life happens, right? So we again, one-stop shop. So really the challenge isn't to pick the best investment for our clients. The challenge is more so to pick the right investment for each of you individually. And at the end of the day, what we're left with investors, at the end of the day, is our after-tax and after-cost returns. So we follow a couple key tenets. We want to own tax-efficient investments. We want to keep our costs as low as possible. And we want to own the right assets in the right accounts. So in addition to that, making sure the money goes as far as the share it, coordinating with estate planning attorneys, making sure it's aligned with what the getting your best return on life as far as dreaming the financial plan here. Oops. And the one thing I do want to point out just real quick would just be the protected piece. Watch me click through all the slides, is the risk management part. So I used to have all my life insurance, health insurance licenses. I've let those go, not because it wasn't lucrative to sell folks life insurance, but because I think it's kind of a cruddy way to have a relationship with an advisor. Like, all right, new XYZ client, you you make a ton of money, high income professional, maybe you got a young family, you need a $2 million life insurance policy. Well, obviously that pays me more than a $1 million policy if I'm also the agent, right? And it just blurs the lines. And candidly, it's kind of a shitty way to have a relationship with somebody that you're supposed to be trusting with your life savings. Do we really need that, or is Ben just trying to get paid more, or would a $1 million policy have sufficed? So because we don't get paid to, I'm never going to recommend anything you don't need. As far as what can you expect when we work together, again, just quickly running through this here because I know we're getting close to that 1 hour mark here at 8 o'clock. Semi-annual meetings, we meet with clients twice a year. We do that tax prep, annual cash flow game plan in the fall. We do the pro forma tax return projection, make sure we don't miss any of those opportunities. And then we put together, most folks are usually in their open enrollment period. So just making sure we don't miss anything from the insurance standpoint. Every quarter, investment performance, market performance, net worth performance, progress tracking, and then market commentary. Hey, here's the tweak, how we had things positioned over the last quarter. Here's the tweaks in our position and outlook for the next quarter on the investment positioning. And then every month we send out a different vital sign. And again, it gamifies these scores because not only do we benchmark it against our client base, which is mostly 1099 CRNAs, but the rest of the 5,000 and some folks that actually use that software. I got the guys that make the app to send me all the back end data and did a bunch of calculations. So it's pretty neat. It gamifies some of these things. Makes it a lot less like, eating your vegetables, sometimes looking at money or going to the dentist. So in addition to that, we have a weekly commentary, which if you've subscribed to our newsletter, I'm sure some of you have seen that. And then we don't charge by the hour. So we don't have any, hourly rate as far as, life happens, right? Divorce, kids, new contracts, you're bouncing around. We can always jump on a quick call. The way we structure our fee arrangement is basically we have 3 different service models. Before I jump into these though, and don't jump ahead on me, there's one thing I do want to point out because it's, again, I'll get on my soapbox here for a second. This keyword fiduciary you see at the top. That is a buzzword that is thrown around so much in financial services. And if you're on the hunt for kind of a trusted partner, you can't avoid seeing that buzzword. Here's what it means. Legally, a fiduciary has to put your interests ahead of their own. Seems like a no-brainer, right? You would think that would be table stakes. It's kind of like the first do no harm, right? In the medical world. So the key distinction, and I guess before I go any further with that, I've never met an advisor that does not claim to be a fiduciary. What most advisors out there, about 80% of advisors out there, are dual registered, meaning they are registered to sell commissionable products and can claim to be a fiduciary because halfway through the meeting, they changed hats and promoted something that they're a little bit more incentivized to sell. I used to work for Charles Schwab. It was never a surprise. Client would end up with a Charles Schwab account and Charles Schwab mutual funds in their account. And if I did enough of that, I'd get to take my wife on a sales trip cruise to Hawaii every year. That is not good, right? Like that's not clear-eyed advice of, there's the guy working at the Ford dealership is going to try to sell you an F-150, right? So that doesn't exist. The key distinction here is this fee only. I don't earn any commissions. I don't get kickbacks. We want to invest in the S&P 500. I don't care if it's with Vanguard or Schwab or Fidelity. I want the cheapest way to get the exposure there. That's how I run my own money, right? I don't have an incentive to, use the American funds version of that. So the wholesaler comes into town and takes me out to a steak dinner once a quarter because I sell a certain amount of American funds. It's how a lot of the industry is set up. And quite honestly, if you've made it this far through the presentation here, it's one of the biggest reasons I started my firm to begin with. It's always ironic talking to CRNAs or nurses. Nurses are the #1 trusted profession in America. Financial advisors are the #2 least trusted. So that's just why I hammer on this, just because I know there's a lot of bad rap out there and a lot of it has to do with how compensation is structured, right? It's like, however the saying goes, like try to get a man to understand something when his paycheck depends on not understanding it. And I'm sure there's a lot of, OR conflicts of interest in the money that's involved there. I'm sure many of you would agree with there. So main takeaway is this: I am only paid by you. So the key here that I do want to point out, we do not offer tax prep or financial planning as standalone services. Like just to be explicitly clear on that. The reason why is because we insist on doing our best work possible for clients. And that requires us to manage the whole financial picture, right? So for example, it's not just about how you fund an account, but it's also about how it's invested once it's in that account. Every single decision impacts the next, right? Tax planning, cash flow, risk tolerance, insurance, investment strategy, all of those things need to be coordinated to achieve the most optimal results in the long run. And if for a fee that we're going to charge our clients, I want to be confident that you're going to get that fee back in spades in the long run. The only reason anybody, me or anybody else, would ever partner with a firm like ours is because you believe that you will have more money in the long run rather than going it alone. Plain and simple, right? So I want to be confident that for that fee, I better be damn well confident that you will be content and happy in the long run. Otherwise, I won't have much of a business, right? So that's why we really are set up to kind of be that proverbial one-stop shop. As far as the distinction here between the different service models, we started doing this earlier this year, where we'll working with SRNAs, really helping them build a foundation. Again, I've enjoyed the educational part of it, going in and talking to the local cohorts and stuff here in Michigan. And so basically we do SRNA taxes for free while they're in school. Now, most folks on this call aren't going to be SRNAs, so we essentially have two service models. We have an investment management only model, and this would be for folks that, like the portfolio strategy we have in place, but they kind of want to DIY taxes and planning. Obviously, they're not going to get the most bang for their buck there, but we still offer it just as a solution to have on the shelf. Most folks opt for what we call this On Point Plus. So it's everything in the On Point portfolios plus all the stuff we've already talked about, multiple meetings throughout the year, us filing your tax returns for you. Everything's kind of soup to nuts included in that fee. We don't charge separately for the tax prep. So how the fees work is we charge 0.1% based on any of the accounts that we manage. So if I manage $100,000 solo 401k for you, the end of that month, save you from grabbing your calculator, that would be $100 at the end of the month for managing that account. In my opinion, and I'm obviously biased, but in my opinion, this is the best way to align our long-term interests, where the better you do, the better we do. Meaning you want to see that $100,000 grow to 150 grand. I'm getting a pay raise, same flat percentage on a bigger number, and you're happy because the account goes up. The opposite happens, and it goes to $50,000. The account gets cut in half. You're going to be pissed off. You're going to fire me, and I'm going to potentially lose your business altogether. And even if I don't, I'm going to get a huge pay cut. So it aligns our long-term interests on the investment management front. And then essentially we have breakpoints where every $1 million that we manage for folks, there's basically a 20 to 25% reduction at each rung on the ladder. We get economies of scale strategy-wise there. Conversation for another day. Most folks opt for the On Point Plus. That's everything in the investment management. And then we charge an additional $100 a month. That includes all those other meetings, tax prep, everything soup to nuts. If we are filing an S Corp for you, we charge an additional $100 a month. Candidly, it's not for us to nickel and dime you. It's just for those of you with S Corps, still very competitively priced relative to, I think, the offering that we have is candidly just more time, a lot more time with the S Corp. But obviously, it's worth it given the tax savings. So that's really the structure of how we have the fees set up. We talk about conflicts of interest a lot. There is one major conflict of interest, just to call it the elephant in a room. When we manage more money for you, we make more money. Now, I don't know if that's necessarily a conflict of interest, because that should be a good thing, right? We're winning the game. Your accounts are going up. We're achieving a higher net worth together. We're also earning more in the long run. I don't, in the sake of transparency, that is the major conflict of interest. We want to manage more of your money because we believe we're the best at doing it out there, and coordinating all these things together. So typically, and again, I thank my wife for a lot of the CRNA jargon on here. I probably could only guess what half the things on here add up to, but basically we're at that element stage. So we would have you fill out that Elements app, and then I'd send you the video. We want to book a call from there. We can really get in the weeds on really start to implement all these different things. With that said, I think I got one more slide here. All right, so here's those QR codes again. One on the left is for that free checkup where I'll send you the video. If you want to kind of jump to the head of the line and fill out that app and book a meeting, and we can walk through it in real time. And if you're really serious about like getting going on some of these things, I would definitely use the QR code on the right. Again, not like full transparency. We will probably only be bringing on 10 to 12 more new clients before the end of next tax season. So if this is something you want to do, not only before the end of the year and like, yep, let's really kick the tires and make sure this is a good fit, please book the meeting. I did this at the end of the last year's webinar, and it filled up in only a few days. So again, that's not a sales pitch. I think to do this job the right way, probably maxes out at maybe 150, maybe 160 households at the most. Obviously, we're pretty involved with a lot of these things. We're at about 135 clients right now. So that's kind of where that capacity limitation comes from. So that is, I'm going to leave this on the screen and then make sure. Any more Q&A? All right, Patrick, one more question on real estate. Does real estate property value factor into your fees as well? No. Nope. So only the accounts we directly have investment authority over. Most of the time, if you're still W-2, we can't even manage the workplace retirement plan. I still want to advise on it, but I'm not going to charge you a fee on something you might only have a couple choices on, if most plans don't allow an advisor to manage it directly. Same thing with real estate, equity you have in real estate, or same thing with cash you have at the bank. It's just literally the accounts that we would have the discretionary trading over. Yep. So I think that's about my time on the 1 hour presentation here. I'll stay on for a couple more minutes. Looks like a few people are still signed in for who's attended. Oh, there's more questions here. Thomas from Facebook. Let me see here. Do you use the Augusta rule? Yes. Yep. So the Augusta rule can be done for those of you that don't know, what the Augusta rule is, actually gets its name from Augusta, Georgia, where they play the Masters. So it's so expensive to go view the Masters that to give you a little IRS history, they actually came up with this rule so people could rent their house out for those 2 weeks and not have to pay taxes on that income. So you can rent out your personal residence for up to 14 days. There's some nuance to how the rules calculated and everything. In combination, you can do that with also your home office reimbursement, whether you have an S Corp or LLC. So there's some calculation things like what's the fair and reasonable wage, for the nightly rate for that 14 days. You have to be pretty buttoned up. Really, it's the lens I try to look at it through is not only if we're ever audited by the IRS, but like literally if you had to prove it to yourself, right? What would be the argument you'd be making? So yeah, there is the ability to do the home office and the Augusta rule. I think is your follow-up question there, Thomas. So the distinction there has to be mostly with like S Corp versus LLC. So again, there's the ability to do both. You just really want to be ironclad, and you can't say you're renting your house out, right? If you live in a $200,000 house, you can't say you're renting it out for $3,000 a day for 14 days to your business, right? That's going to be a red flag. Now that might exceed doing that versus the square footage deduction. Again, there's some nuance there, but that would be kind of directionally, I guess, the lens I would look at it through. I'll stay on for a couple more minutes in case any more questions come through here. And I will be sending out the replay. We'll blast that out, email to everybody, and then as well as the questionnaire links to the resources and everything. Probably stay on for, I don't know, another minute or two, see if any more questions come in. Absolutely, Anita. Happy to provide some good info. If anybody's still on, and we're going to try to do a couple more of these in the next year. If there are any specific topics that you'd like to be covered, feel free to shoot me an email, and I'd be happy to hit it on the next go around. Patrick just booked the meeting. Download the Elements app. Yeah, I'll shoot. If you book the meeting, Patrick, I've got your email, so I'll send you the link directly. That way, it's lined up with your email and everything in our system. And then, yeah, that'd be perfect. We can kind of kill two birds with one stone. We'll go through the app together, and we can go from there. All right, everybody, 8:07 Eastern time here. Everybody enjoy the holidays coming up here. Be safe. And yeah, look forward to hopefully chatting with you all soon. Take care.